Hello traders, welcome back to my channel. Today I will be explaining a short setup on NQ that happened on the 21st of August. I will be discussing how I decide my bias for today and how I mark my key liquidity points from the higher time frame and why, from the 4 hour, 1 hour and all the way down to the 1 minute entry. So, first of all, we start with the bias for the day. So, like usual, as I always say, once price took this 4-hour major low down here, I turned my bias to bearish. And just to keep it in simple words, then price retraced, took this liquidity point that I have marked and did a bearish move, as you can see here. So that's why I will be looking only for short setups. So price then did a small retracement here and then again did a bearish move here, which made a break of structure. So I will be discussing this price action movement here, this one here. So as you can see, I'm still on the 4-hour chart, and on the 4-hour chart there is no there is this point of liquidity, but price didn't go above this point, so let's still write it down. So we have these 2 points of liquidity on the 4-hour, but price of course didn't went above them. So I will be going down on the 1-hour and show you how price action was right there. I will be deleting these two. So now we have a more open picture of the price action on the 1-hour. I have marked, as you can see here, there are these 2 wicks. I have marked the 1-hour key liquidity point that I'm interested in for price to go above, and then I will look to short. And I have marked also this point here. So once I have marked those 2 points, the only thing that I have done is to wait for price to go above, which of course it did. Now I will drop down to the 1 minute time frame, and I will be explaining why I took this setup. So always remember that because we mark the liquidity point on the higher time frame, when price goes above that point, you need to give it some time for it to form our usual pattern for us to take the short setup. Sometimes it forms immediately, but of course sometimes it doesn't. So as we can see here, price went above our 1-hour liquidity here, then it reversed, as you can see here, and it didn't give us the entry pattern that I was looking for. So then again price did a bullish move. Let's say it did a new high. Let's write new high, and again it made a bearish move. So once I have seen that bearish movement forming and it started to retrace like here, I have plotted my Fibonacci. So I've plotted my Fibonacci like this. Then I have marked a key liquidity that I wanted for price to sweep, which was above the 61.8, which the most point that caught my eye was this point here. So once price took that liquidity, I shorted the market. So how I shorted it? If you can see, if you zoom into your charts and see this candle here, there was an IFVG, which I will mark, small IFVG. Once price went above that liquidity, I waited for price to fill that IFVG, which happened with this bearish candle that formed here, and the entry was executed. The stop loss was set at this high, and I took 2.5 R like always. So on a Friday I like to close early. With 2.5 R I'm more than happy, because on Friday there is like a little bit of volatility, so I wanted to keep myself out from there. So once I made my 2.5 R, I just closed the trade. Of course, as you can see, price kept going lower, and if you happen to take the same setup that I did, you would have gained, let's say, 12.25 R. It was something 12.4, 12.5, something like that. But I love not to be greedy, stay humble, and with 2.5 R I was more than happy on a Friday. So just a quick recap: we decide the bias for the day, we mark key liquidity points in the higher time frame, we wait for liquidity to be grabbed on the liquidity point that we have marked, and then we wait for our usual pattern. Price goes above the liquidity, a bearish movement, retracement, sweep, liquidity grab on the 1 minute, and the short to be executed after. So for today's video, that's all. I hope that you enjoyed and liked it, and if so, please leave a like in the comment, and I see you on the next one. Thank you.